Unstoppable. Relentless. It's the ironclad investment discipline. Every year when you file your taxes, shortly thereafter you're going to get a document called your Notice of Assessment issued by CRA, Revenue Canada. And this document is a really important document because it often identifies tax planning or tax saving opportunities, which is why we collect that document every year for our clients. So in this short video, I'm going to share with you what it is that we actually look at when you send us this document. And so let's start with the basics. The RSP contribution. The first thing, the Notice of Assessment for our working clients, is it clearly identifies how much RSP contribution room you have. And so we just take that. Let's say you had 30,000 of RSP contribution room. We put that into an Excel spreadsheet for every client, A to Z. And then in January, February, someone on my staff will reach out to the client and say, okay, you have $30,000 of RSP contribution room. How much taxable income did you have in the previous year? Pull out the tax tables and we'll figure out what's the optimal amount to put into the RSPs. Maybe it makes sense to put the whole 30,000 in, maybe it doesn't make sense to put the whole 30 in. We use the tax tables to help determine what that should look like. So that's the first thing we do. That's pretty basic. The second piece is not as basic, and we see a lot of people get tripped up by this. And it starts with, you do not have to claim the tax deduction when you put money into your RSP. So simple tutorial on RSPs, you put money into an RSP, dollar for dollar you get a tax deduction for that amount, multiplied by your marginal tax rate. That's what you're going to save in taxes. Sometimes clients expect their taxable income excuse me, to be far higher in the future or in the near future. Therefore they forego the tax deduction and they wait till a couple years later to then claim the deduction. The problem is they often forget to claim the deduction. In other words, it just gets carried forward year after year after year. So we look at the Notice of Assessment, clearly shows me what your taxable income was. I then look to see, okay, you were in a high marginal tax rate. Why didn't you claim the deduction that you had from previous years, the carry forward? And then we'll make a recommendation, either call your accountant, file an amendment, you do an amendment, or at the very least, make a note in April in your calendar to remind you or your client, your accountant, to claim that deduction. So a lot of people get tripped up, and it's a bit confusing, the wording on it, un-deducted RSP contribution room on your Notice of Assessment. A lot of people get tripped up by that, and we help fix that when we review and analyze the Notice of Assessment. The other piece on RSPs is, again, I clearly can see what your taxable income is, right? Therefore I know what your marginal tax rate is. And I can see how much money you put into your RSP. And often I'll see clients that are making 30, 40,000, they're barely in a 20% tax bracket, and they're putting money into an RSP. And I know what their taxable income is going to be in the future because I have a written financial plan that clearly forecasts what their taxable income is going to be. And many times their taxable income is going to be way higher in the future, which means they're getting a low marginal tax rate savings now, and they're going to pay a far higher tax rate when they pull money out. So we're able to nip that in the bud and remind them to stop putting money into the RSPs until their taxable income justifies it. The next piece that we analyze is for our retired clients, and they are often income splitting. Again, simple tutorial on income splitting. You can have two spouses and split the income so that you're paying taxes on the same amount each, versus having it all taxed in one spouse's hands. And by doing so, you're potentially getting yourself both into a lower marginal tax rate. And so we're looking at the combined income, we're looking at the income for each spouse, and we're looking to see, did they miss an opportunity to split some income? So you're allowed to split your pension income, you're allowed to split money that comes out of your RIF. Did you do that properly? That's another piece of low-hanging fruit that we analyze when we go over the Notice of Assessment. And then there's one that I've talked about, the strategy of maybe it makes sense for you to pull money out of your RSPs or your RIF prematurely if you're in a lower tax bracket today than what you're going to be in the future when you're required to take more and more money out of your RIFs and RSPs. Again, I did a whole video of this on my YouTube channel. I encourage you to check it out. But really, that strategy, where I get the information to see whether or not this strategy even makes sense is from the Notice of Assessment. So really important that we analyze that to see if there's an opportunity for you to start pulling money out of your RSPs prematurely to save to pay tax at a lower rate than what you will in the future. And then another important piece that we look at when going over the notice of assessment is capital loss carry forward. So when you sell a stock or an ETF or a mutual fund at a loss, you get to carry that loss forward, and it shows you the amount on your notice of assessment. You can carry that forward indefinitely to offset future capital gains, a year when you do sell something at a gain, and then you can offset that to reduce the tax bill. But you can also go back 3 years. And so we have the notice of assessment on file for every client. We keep them. So if you have a big amount of capital loss carry forward in any given year, and I see that on the notice of assessment, someone on my staff will look at the notice of assessment from the previous year and say, oh, well, this client had a huge amount of capital gains last year. Let's get them or their accountant to file an amendment, take those capital loss carry forward that they have now, and go back and offset last year's gains and get a corresponding tax savings. Can sometimes be significant. Those are the main pieces that we look at. There's other nuances, but those are the main pieces that we look at when collecting the notice of assessment. And look, without sounding like a commercial, let me close by saying, I've been doing this for 30 years. I've yet to meet another advisor, including my own colleagues here at RBC, that collect the client's notice of assessment and review it. But it's who I am. I want to make sure we're doing everything we can to help you minimize your taxes. And when analyzing these documents, really it's done in conjunction with a written financial plan, which we have, I'm proud to say, for 100% of our clients have a written financial plan. And when I look at their future income versus what it is now, that's really where this document comes into play. So it's analyzing this in conjunction with their written financial plan. If you're not getting this attention to detail, you don't have a written financial plan, again, I'd love the opportunity to pick up where maybe we've left off, or if you're just seeing this for the first time, reach out to me. I'd love the opportunity to see how I might be able to help you. If you are a client and you're wondering why I collect this document every year and have for many, many years, hopefully this gives you a bit of an idea as to what we're actually doing and what we're looking at when we collect this document. In the meantime, appreciate your viewership and be well.